insurance is inherently confusing. Whether it's your residential home or you're operating a short-term rental business, it is a key part of managing your risk financially.
Thanks so much, Nick, for agreeing to jump on a call and having a chat about the state of months here with two very significant storms, hurricanes, and incidents that I think many people are feeling a direct impact, and some people a ripple down effect.
As much as we can do to provide a kind of a much more deeper understanding of how insurance contracts work, I thought I had insurance, or I didn't understand how these limitations are on the macro level. What does this mean for the industry moving into 2025?
I think it's, really interesting. My entire background has been employee benefits, educating people on what they're purchasing, what they're covered for. And the sad part is it's never an exciting topic.
Yeah.
It is obviously really important because you're talking about protecting assets and lifestyles and your business and your family. And so that's what I was hoping we could kind of talk through, because it's easy to point the finger back at the insurance company that is maybe not approving a claim or approving it for a lower amount than I thought I was going to have coverage for. And I think it's really important to sort of look back at what is first the role of insurance.
The role of insurance. So when you go back to like the raw commercialization of insurance, it dates back to 1688 in Edwards Lloyd's coffee shop in London. The term now is transactional risk transfer. And when we think about insurance premiums, one thing we try to coach our clients on is like, look, premium is based on how much risk you are transferring. But the one thing you will never get in insurance is a 100% transfer of risk onto a piece of paper. No matter how comprehensive the product you are buying, no matter how comprehensive we can be in what we do in our business with vacation rentals and midterm rentals and Airbnbs, however you want to categorize it, we cannot cover everything. Simple equation: the more risk you transfer, the more you're going to pay, or less risk you transfer, the less you're going to pay in your premium. I think that's like fundamentally kind of item number one to think about, is to remove cost from the equation initially and spend more time looking at the contract, having those deep conversations with the provider and with your agent. Make sure you're partnering with an agent that intimately knows what you're doing, business related. So for those who don't know Proper, we're a broker. But we're a bit more than that. We're what's called a cover holder within the Lloyd's of London market. There's only 4,000 of those, give or take, in the world. How it works, we present a program to Lloyd's of London, and they say, yeah, we believe in your ownership. We know what you guys do. The history of our ownership in the hospitality industry for insurance is they've been doing it for a long time. So there's a lot of trust with the carrier allowing us to do this. Like, that's all we do. I don't sell auto insurance. We only insure short-term rental homes. So we know that better than anybody in the market. It's like, I think the best way for me to put it, it's like putting together a 1,000-piece puzzle. It's very daunting when you first open up that box. There's a lot of pieces to that puzzle. But once you start getting the border put in, and then you start putting in all the centerpieces, you start to get a better look at the picture. And the closer you get to the finish line, the easier all the pieces start falling into place. You're looking beyond price and more about what's in the contract and how particular coverages engage, when they engage, how that process works. You start to really understand what risk is actually being transferred to the company in terms of my premium versus what I still need to self-insure on my side. And it's different in every part of the country. That puzzle is going to be a bit more complex as we get closer to coastal areas than it is going to be in areas like Illinois or Michigan or Montana or things like that, because we don't have these particular risks geographically.
When we look at it from a commercial side, I've got big healthcare centers that went without wind coverage because the premium and the deductibles got to be so high. The deductible was $2 million. He's like, I can replace 10 roofs for what I would need to do with this.
There comes a point where at this time, the carrier, and again, using Lloyd's as the example, where they go, look, we're paying more in claims than we're collecting in premium. So we either strip away our coverage or we raise rate. And so we raise our rate. And then we have, large natural disasters happen again. You have fires in Tennessee. You've had the ongoing fire problem in California. You have the continuous battering of storms, the southeastern United States. And so your rates kind of go up. With us, we have a lot more. We have liability. We have property damage caused by guests. We have all these things that swirl in this, and the rates have to go up. And now, like for us, 10 years into this, we're at a pretty stable rate structure. Very marginal rate increases. Some markets by a zip code specifically may be a worse risk than a neighboring zip code, and we end up charging more rate in that particular zip code because of the losses, so we can be a bit more structured. Putting that into terms of like the regular marketplace, our storms are getting bigger, our storms are getting stronger, they're getting more devastating, and we have the increase in the urban and suburban population with construction. So we have a lot more population densities. As the storms get bigger and cause more damage, they're causing more damage to more properties. That's what we kind of deal with. We've had storms, we had fires, we had tornadoes, we had hail. Folks in Texas, for example, they had 2 massive freezing events 2 years in a row. The average rate increase in Texas amongst the retail insurance market was 60% in the state of Texas. And that's to save the insurer's business. So it is a give and take, right? Us as consumers, I got to buy insurance too. I've had rate increases with Allstate on my auto and my homeowners here in Montana. It's you either continue to pay that premium, or enough people start saying no to those rates, leave the market, and then you're left with very, very limited options.
When you get into the bigger property and casualty type of claims, you don't realize you don't know the policy or that you're not covered the right way until it's too late. So oftentimes, even if you're trying to work on a renewal and you want to get additional proposals or additional options, once there's a named storm, you can't even bind coverage, right? And that's the big protector that's out there for insurance companies. They're not allowed to bind coverage. Those are regulations that are set out. Sitting here, I mean, I have my personal home. I have multiple properties that were in the direct line of fire of both storms. I too am a broker on the benefit side, not the P&C side. But as I'm sitting there and I'm listening to the governor speak about what the prediction is before the storm even hits. So I think the only way they get out of this is by mandating certain coverages across the board.
California did this years ago with fire insurance, and then also with earthquake. Earthquake insurance, for example, is very, very expensive because if a big earthquake hits California, which is very densely populated, it's going to be a massive bill from the insurance company. So of course they're going to charge a ton of money for earthquake. People weren't able to get earthquake, but still want earthquake. So now you have the California Earthquake Authority. And then now you also have, with a bunch of carriers pulling out of California due to forest fire risk, they are no longer writing insurance. So now you have what's called the California Fair Plan. Fair Plan is for fire coverage. So you can at least have that on your home, which is the basic requirement of all lenders that you have on your property. I've thought for years that Florida should move to something like that from a wind and flood standpoint, where they have a wind program, because I won't shy away. Our wind insurance is expensive. I mean, you know that as a client down there, and our wind premiums are pricey. Part of that is due to the back end of the coverage with covered hurricane damages within the contract. We also pay loss of business revenue. So again, you're transferring more risk, so you're going to pay more in premium. Now, if you're familiar with flood insurance and you know as a residential property, you have limit caps, typically set at $250,000 for residential, $500,000 for commercial. If you got a very large home that sustained a lot of damage, your max benefit for a residential property, if you have that coverage, is only going to be $250,000. But you're also paying an arm and a leg for that $250,000 in coverage. And if it's not required by your lender, you're not going to go out and buy it. Another interesting data point that I was able to track down was that only about 2% of U.S. properties carry flood insurance. So we're talking about at least 98% of folks who suffered this storm surge damage from these hurricanes are self-insuring, more or less. Going into the shoes of a consumer who maybe is not fully understanding all the pieces to the puzzle, like I was saying, and you're just like, I want my premium to be cheaper. And then the agent goes, here, I found you a cheaper premium, but you don't really ask why. And then you find out you don't have hail coverage, and now I'm out $20,000 to replace my own roof. And that's the trade-off of that lower premium. I think the biggest thing here for a lot of folks who are listening might go, well, okay, Nick, so I bought a contract, whether it's our contract or another company's contract, and it has loss of rents or loss of business income tied to it, and a hurricane came through, and now I don't have any coverage response. Well, it's because the damage was caused by an excluded cause of loss, right? So if your damage was purely from storm surge, there is no income on your regular home insurance policy or whatever policy you have in place on that structure. There might be some response if you have a commercial flood policy. Perhaps I'm not intimately familiar with those contracts either. It's not my expertise, but I would imagine that a commercial flood policy probably provides some loss revenue protection. And so if you have that, that's your means of recourse. So the big thing here is if you don't have a covered cause of loss covered on your contract, then that loss of income or loss of rents doesn't respond. That is where there's a lot of frustration that comes through right now where we're at after these storms is you either excluded wind or hurricane on your current policy, or you have wind and hurricane coverage, but the damage was via the storm surge, which is not a covered cause of loss. It's only picked up on FEMA or a flood policy. And so you're not going to get paid income part of the contract. And it goes back to what you were saying. That's where insurance companies do protect themselves. Otherwise, insurance will become so unaffordable that nobody will have insurance,
Yeah,
you
and
know?
I think it's important when you read that contract because the reality is beyond that limit of $250,000, you have to look at what's covered under that flood policy. You have to understand the footprint that's covered, swimming pool, your driveway, some of those things that they might come under the $250,000, but they're not going to be covered. If this floods, your oven, your refrigerator is not covered, even with a flood policy that you've purchased outside. So, how are we going to account for that risk? Because everybody's risk tolerance is different. My risk tolerance, knowing that I own my properties that I manage myself, is very different than, say, a homeowner who has one home and is using a property manager to handle this and they don't really know the weeds of it.
One thing we run into a lot are hurricane. We don't, it's not hurricane insurance with
Mhm.
us in Florida specifically, it's just wind. So it
Right.
doesn't matter if the wind is 1 mile an hour or 1,000 miles an hour, it's wind. So you either have it or you don't because it's an option. What we see with a lot of folks is like they'll buy our policy without quote unquote wind. And they're under the impression that by keeping their regular home insurance policy that has wind, they would be covered for a hurricane. So you hit the nail on the head because a lot of those policies that are sold in those coastal areas, they have coverage for tropical storm, but they don't have coverage for a classified hurricane. So that's another thing where you might go, look, Nick, I did the puzzle. I made the conscious decision that I wasn't going to buy proper with wind and hurricane because of the cost, but I'm keeping my regular home policy, which had wind, but we didn't get that last piece of the puzzle in place where it's only tropical storm. It's not classified hurricane. So when the adjuster comes in and goes, look, it was classified by a hurricane, it was a hurricane. It was a Cat 3 hurricane. You don't have coverage for it. That's where there's some additional layers of frustration for folks. And I don't have any control over what your other policy is or what it says. So that's just another kind of piece that you have to try and figure out, especially if you're in that Florida market. Do I have hurricane, or do now I need to have four insurance policies on my home? I have my regular homeowners insurance, which I know doesn't cover short-term rental business activity exclusion. So I go and buy another layer of coverage through a company like Proper that does the short-term rental business and the property coverage and the liability without wind. But then I need a flood insurance policy. And then do I need to go and buy just a hurricane policy as well? And so those are things you need to think about. But then also, as you kind of put all those pieces together, kind of circle back to each individual carrier and see, hey, do you guys actually cover what this one's doing, so I don't actually have to buy that policy? And that's one thing like we like to talk about. It's like, look, the reason we classify wind as wind with our program is so that you don't have to go and layer all of those coverages. In theory, and the way it really should work is that you do spend the money with a company like ours. It's going to have that more comprehensive wind protection, and then you get your flood policy. And so you're not stacking and layering all these different premiums, and then now you have a lot of insurance contract language to try and learn. But for some folks, that's how they end up doing it, and that's perfectly fine. Yeah, there's a lot of complexities to it. I think a lot of folks miss the wind language in the residential policies in these coastal areas, that it's only tropical storm in a lot of cases. It does not include hurricane.
Yeah, I know we have to have a very specific hurricane policy here. And, your lender is going to require that too, but it's got a much higher deductible. When I talk to my clients, because I handle, the employee benefit side, and you've got people who are totally displaced. I mean, yesterday there was a condo in St. Pete near just across the Gandy where the whole thing was condemned. 500 people told they don't have a home anymore. And because it's taking time for people to get to those buildings and condemn them. So there are people that are really struggling emotionally with how do I figure this out? And we didn't even touch on the auto market here, but the amount of cars that were lost due to flooding, so that risk management factor that you go through, but then figuring out what is that deductible, whether it's a hurricane deductible, a wind deductible, a flood deductible, or the amount above the 250,000, how you solve for that, because everybody has a different comfort level. I would say there's probably very few people that are super flush with cash and are really excited to stroke a $2 million check to repair their home.
The deductible thing too, that's, most companies now, we're starting to see in Florida, including ourselves, have a 5% deductible on wind and hurricane, or a $25,000 minimum. So if your insured value between the structure and the contents inside the property is $1 million, you're going to have a $50,000 deductible for wind related claims. So there's a couple of things you need to look at when you're building that policy. Is one, okay, so I got $1 million insured value. I know I need to have $50,000 in my pocket in order to even get anything back from my insurance provider. And I'm not talking about flood on this, because again, that's a completely separate thing. You get this big storm and your roof is ripped off. Okay, well, that's $25, $30, $40,000 right there. Okay, so that's part of your deductible. You might have water damage from wind driven rain because of the roof damage inside, and you got to replace flooring and drywall. You might have some broken windows. You could easily get to 75 to 100,000. I pay 50, the insurance company pays 50. Hopefully you have built those cash reserves and you kind of understand that. And then the other aspect to it is, again, when you have a covered cause of loss, that loss of rents or that business income. So we do business income because it pays more than loss of rents would. Now you look at, what is that limit? And one thing I try to advise everybody is, look, at least have enough income coverage, as long as your books support it, which I feel a lot of properties in Florida do support, especially $1 million home. Like, you're probably doing 50,000 or more gross revenue on your short-term rental. Have at least that income amount, because then that's going to put that $50,000 back into your pocket that you had to pay out. But if you're out $100,000 in revenue, you really should be paying the additional premium for that 100,000 in revenue, because when a big natural disaster like this happens, you're not getting your house fixed next week. This is going to be months and months and months and months, and you can continue to receive that benefit like you were still short-term renting. So if you were down for a year and you insured for 100,000 in gross revenue and your books support that, like through Proper on a covered cause of loss like that, we are going to pay you that $100,000. You got your money back from the deductible, plus you get some of your profit back as well to either replenish that or at least continue to pay that mortgage and property tax, because that stuff is not going away. And worst case scenario, let's say you don't have flood insurance, and then of that $100,000 in damage, there's another $25,000 or $30,000 in damage that is flood related that wouldn't be covered on your regular home policy. You're still getting that profit from the income, and you can use that however you want. So you're going to end up using that to fix the drywall below the flood line, replace the furniture, replace the appliances, things like that. So that's, again, where it comes into, like, when you're building this piece of the puzzle, we have to look so much further beyond just the cost and look at how much would a claim actually cost me. If I have a claim that would have been covered on your policy but decided not to engage with that coverage due to the premium, how much is it going to cost me in the long run versus leveraging the insurance policy? And I will say, like, for most folks with hurricane damage, not storm surge, but the hurricane wind damage component, you're going to win that bet against the insurance company almost every time, because they're going to end up paying you more in the damages and losses than they're going to collect in premium in 10 years. It is really important to dive into that, deeply. Don't just have a phone call, look at a quote and say the number looks good and then buy it. Really understand what it is so that you can leverage that. If you've ever seen me talk at a conference, which, even though insurance talks usually have low attendance, but if you've ever been in them, trying to explain to folks, it's like, look, we're using insurance as a tool to leverage against losses. The best insurance policy you will ever buy is the one you never have to use. Unfortunately, in the space that you and I are in with short-term rentals, the data shows we're going to have a claimable event once every 5 years. So you kind of know within 5 years, you're going to leverage that policy in one way or another. The gamble of the premiums is actually highly worth it to go with a higher protection value on the policy contract to ensure that, at the end of the day, you're going to win against the insurance company. It's our job to find coverage. It's our job to try and make sure that you're covered and tell the insurance carrier that writes the check, like, this is the size of the check you need to write. But at the end of the day, we have a contract, and that contract tells us what is and what is not covered. And if it's not covered, it's not covered.
And that's a key thing. And it's,
Yeah.
your contracts are long. My contracts are often longer.
100
When,
pages. Yeah. It's a
yeah, a
lot.
couple hundred pages
Mm.
where you're getting into the weeds of all the granular stuff. The liability piece I wanted to talk a little bit about, because there are some amazing property managers out there, and there are some not so amazing property managers out there. And it's been interesting to kind of listen to how some people have reacted on the liability front.
One thing, like, because we deal directly with the homeowner. So the homeowner comes to us and they're using Ratcliffe luxury vacation rentals, let's say. And they go, well, I guess I don't understand why I need all of this liability protection because my property manager has liability insurance. It's like, well, yes, your property manager does have liability insurance as a operating short-term rentals, but where you need to kind of change the mindset is the property manager is actually not the business operator in this sense. You, the homeowner, have contracted with a third-party contractor to help you manage your business. So you need to have these structured, layers of liability. And I like to call it amenity roulette because every property offers different amenities. So based on what type of liability coverage do you have coverage for that amenity? Or are you just spinning the roulette wheel and hoping it doesn't land on your number? So your property manager, yes, they're going to have typically a relatively robust insurance policy. We do have a sister company called Wister that specializes in business insurance for property management entities. And those liability coverages are, for the most part, a la carte. It comes down to what you need. Now, cybersecurity is a big one because a lot of files now are digitized. So a lot of companies are implementing their cybersecurity protections. They have professional liability or errors and omissions, liability to protect them against mismanagement. That's a big one. They have general liability as well, but the general liability is not to protect against a slip and fall at your property. It's to protect them against a slip and fall at their office, kind of standard things like that they may be negligently responsible for. That's where you really need to understand, like me as an owner, I still need to have insurance to protect myself against liability because if somebody slips and falls at my property or gets injured using my hot tub or my pool, ultimately I'm the very top of that pyramid. And so I'm the one ultimately responsible. And then your property manager is going to have their insurance for their thing. So Catherine, if you mismanaged my property in some way, or you made an error or omission in some type of blank check promise to me, which ended up hurting me financially, then I can sue you against your E&O insurance.
But the liability portion, I'm curious because it was really the Wild West here when the evacuation orders were coming in. And there were some people that made the news with the crazy guy in the Tampa Bay that didn't want to get off his boat and all that kind of
Yeah,
stuff.
Lieutenant Dan.
So not everybody required guests to evacuate, even when they were in mandatory evacuation zones.
Mm-hmm.
And some people I know are still trying to get money back from reservations and they want to be able to cancel. And there's no clear policy. I mean, Airbnb has a position of what you should do, and Verbo has their own. But it's really subjective in terms of this is best in class what you should do, and this is, as the insurance company, what we're going to do. I mean, what's proper stance? If I'm in evacuation zone, I am Gulf front, and I tell somebody, no worries, you're fine, ride out the storm.
Yeah, you put yourself in a admission of guilt, more or less. And so negligence on the homeowner is never covered on a liability side. To use kind of a more crazy yet clear example, let's say. So I am the host of a vacation rental. My neighbor calls me and says that my guests are being unruly, and I happen to drive over there and have a conversation with them, and that conversation turns sour, and I then assault my guest. Well, assault and battery is not excluded from our coverage, right? But the negligence of the homeowner is. And so I intended to create injury when I decided to hit that person, so I don't have liability. And the same kind of concept, that same logic can be used if you tell your guest, hey, don't worry about it. My home's hurricane rated. You're fine. Just go up to the second story in case it floods. And then they become injured or there's loss of life. I highly, highly doubt insurance is going to respond to that because you put that on yourself. So my recommendation in that sense would be, if there's a mandatory evacuation order, to always follow that and tell your guest, you need to get out of here. And if they decide not to get out and then become injured and name you in a lawsuit, there's not an exclusion around the negligence side. And then it's our job, it's our duty to get you out of that. Having liability coverage is that's part of it, is that a covered cause of loss, your legal fees are provided for by the carrier. So yeah, that's a tough one.
Yeah, it was weird. I mean, we took a pretty hard stance ourselves, but when you're on those Facebook pages and watching people within my building that let guests stay, like, why did you do that? I mean, how much was that? How much was the rental that it was worth that?
Yeah, and to kind of touch on that too, because it's a phone call we've gotten a lot since these storms, is refunding guests, right? Or after the aftermath of guests canceling. There's a thing in insurance, and it's in all property and casualty policies. It's not something that we snuck into our contract. You have what's called ISO. And ISO is the standardization office for insurance form language. So most insurance contracts are going to share those forms. So one of these is called loss of market. Even if you have all the coverage, you have all the insurance, you got the flood protection, you had the hurricane coverage, you have the loss of business income for covered cause of loss. You're getting all of that. What you're not getting is loss of market protection. Because the storm has decimated a community and now nobody is traveling there, there is no future coverage for your loss of revenue. Now, one thing that we don't sell in our network of companies, we do property managers, we do homeowners, we do the guest damage protection. We don't sell travel insurance. And the other thing I stress at shows is you really need to be pushing travel protection if you're in these markets. If you're in these markets that are subject to storms, we know the hurricanes season is from July to November. Those travelers, we should really, really be pushing that they pay the $60, $70, $80 for travel insurance. For some folks that we've talked to, especially recently just coming back from the VRMA, is what they did was they kind of said, hey, we're sorry you can't come here now, but we'll just rebook you for the next year. And so without doing refunds or anything, they're just rebooking for the next season. And then that way you're not having this transactional, you're hopefully not losing that particular person. And then in that situation, because it's a rebook, you have the option to say, hey, if you're still going to come in October, you might want to look at travel insurance because we're not going to do this again. And so those are some other things you have to look at. It's just another piece of the puzzle in the short-term rental space.
Yeah. Yeah. No, absolutely. I think great recommendations. I know we've gone long here for more than a coffee chat, but I think
I
this is a
think
really important message that people need
Yeah.
to really
Yeah,
listen.
I think you and I could sit here for like hours and hours and just talk insurance, which is always refreshing. It's always great having a conversation with folks who are, a little bit more familiar, and we're able to guide that conversation a little bit more in depth for the listener. Again, like I said, this is a 1,000-piece puzzle. It's daunting when
Yeah.
you open that box, but you have to start somewhere. And the easiest way to put a puzzle together is to start with the flat edges,
Yep.
right?
Flat edges and the
and
corner.
then and then start in the corners and start building everything in from there, and expect to have long conversations. Like you should view insurance as a key component to what you're doing, whether it's your residential home or you're operating a short-term rental business. It is a key part of managing your risk financially. And so you need to have a really good understanding of what that policy says, but not just what the policy says, but also the partner behind that policy, right? You really need to trust who you're doing business with. And we're very proud to say that that's how we've built the foundation of our business. Is, yeah, we make money selling insurance, but really what you're buying is a risk management partner at the end of the day to help walk you through all of this. And that, I think that's really important for the listener to take away. I'm not here to promote us and commercial us and be like, you have to buy us, but finding somebody who's intimately familiar with what you're doing and how to structure a plan around your business and your needs is as important, if not more important, than all of the language inside the contract. And we're always open for phone calls. If you're new to short-term rentals and you think your policy is pretty good, but now you have some questions after listening to this, it's literally no commitment consultation with us. Yeah, we'll get you a quote. We're going to send you a quote so you can take a look, and we'd like to compare to what you have to your other policy, but really to help set that foundation for you to make the best risk management decision for your business. We hope that's us. Of course, we'd love for everybody to be a client, but I can't insure everybody, and not everybody is wanting this level of comprehensive protection that we offer. So, but at least having that 30-minute call, just educate yourself. The more you know, the more you're worth. And we're here to be a resource for everybody.